Good morning. My name is Owen Pinkerton. I'm a partner in Thompson Hine's Investment Management Practice Group. And joining me today is Terry Gallagher, Executive Vice President and Director of Mutual Fund Accounting Administration at UMB Fund Services. Terry and I will examine how private equity as an asset class can be packaged in a registered fund wrapper. This is the second webinar in a row where we focus on private equity. And for those of you who were not able to attend last week's webinar, I highly recommend looking on our website or on our YouTube channel and giving it a watch. Mark Miner and Rich Heller from our team had a discussion with Anthony Scaramucci about current trends involving private equity, cryptocurrencies, and a whole host of other topics. It was pretty insightful and very entertaining. And it's always hard to follow something like that. But luckily, we've had 6 days since then, so I think things have cooled down a bit, and I think we'll be okay. If you have any questions or comments during today's program, we encourage you to join in by using the question and answer box in your control panel. We'll address all comments as we move through our discussion if we can, and we'll try to leave some time at the end to answer these as well if we have time. We promise to follow up on any questions that we don't get to during our time together today. So with that, let's get started. So before getting into specific, it's worth taking a step back and defining what we mean by private equity. I mean, private equity in its simplest form is investing directly in the equity securities of private companies, often for control purposes, but it doesn't have to be that way. Private equity firms sometimes acquire public companies in order to bring them private or restructure their operations and have an exit at a later date. Private equity firms often invest side by side with private debt firms or private or public debt firms who provide the subject company with debt financing, while the private equity sponsor acquires the equity, which is really designed to provide upside upon some sort of an exit transaction. Private equity funds typically are structured as partnerships or LLCs. They're generally offered to institutions, pension endowment funds, family offices, very high net worth individuals. They have very high minimum investment amounts, and they're typically structured so that there's no liquidity for investors for some period of time, sometimes a number of years. Private equity funds, at least the successful ones, also tend to have very outsized returns while carrying a significant amount of risk. And maybe most importantly, private equity is generally seen as having little or maybe no correlation with the public markets. So for a registered investment advisor that's providing a portfolio for his clients, private equity provides some valuable diversification in that portfolio. These characteristics are not what you typically see in registered funds, but we've seen a recent trend of trying to replicate this type of a strategy in a registered fund wrapper. So Terry, there are a number of sponsors that have recently filed registration statements for funds that have some level of private equity features in their strategies. What do you attribute this to?
Well, we've seen a real growth in the, what we call alternative investment strategies into registered space over the last few years, but really beginning after the 2008 financial crisis, as ways to do two things. One, to allow retail investors, if you want to use that, to invest in products or funds that were not typically available to them. To make it easier to invest in those, to make them more like an open-end mutual fund. But at the same time, to allow, it became the buzzword that we heard lots and lots of times about having non-correlated returns. So having investments that weren't tracking markets, weren't tracking other vehicles, and getting into other things like, commercial credit, a private hedge fund of funds, and now over the last couple of years, the private equity space also trying to find ways to become to the registered space to really, as I said, to make it easier for investors to get into it. And a number of those reasons really are around the paperwork process, the way to do your application process, as well as on the tax side of it. Many of the people we talk to are trying to avoid having to do K-1s to their investors that they do in their private, the private side of it, and to be able to use to meet the RIC qualifications of a registered fund and issue 1099s.
Right, that makes sense. So if we assume that there's an appetite at the retail or the so-called, I guess, mass affluent level, which is people who I guess would be accredited investors but are not necessarily the really high net worth individuals who are investing in private equity funds. There are a bunch of different ways to accomplish this. So we're going to limit our discussion on different types of closed-end funds. We're going to, at least for today, ignore mutual funds, ETFs, and listed closed-end funds that may have a private equity focus. You know, and part of that is the performance of those vehicles to some extent is going to be tied to the performance of the public markets in general. So we're plus we only have 30 minutes, so we're gonna limit our discussion to those types of closed-end funds. We've seen a number of different structures that invest to some degree in private equity, and you know they have different levels of liquidity that are afforded to shareholders in the process. You know, when investors or registered investment advisors look at ways to get their clients exposure to private equity, first thing they're going to look at is the history of the sponsor, the prior performance in the space, and that for good reason. I mean, that's where they should start their examination. But once you get past that, it's really important to look at the specific structure and assess the pros and cons of that structure in order to meet the individual needs of the investor. In the closed-end fund universe, we've got tender offer closed-end funds, we have private closed-end funds, interval funds, business development companies or BDCs, and auction funds, for lack of a better word. I don't think that's a technical term, but that's what they're being called. So we'll briefly describe the characteristics of each and then discuss how the structure works or maybe doesn't work as well with underlying private equity assets. So Terry, let's start with tender offer closed-end funds and interval funds. Both of them are publicly registered. They're available to retail investors at relatively low minimum amounts. Shares don't trade on exchange, but they can often be bought on one or more of the large platforms such as Schwab, Fidelity, TD Ameritrade. You know, interval funds provide liquidity to shareholders by having to offer to repurchase at least 5% of the total outstanding shares at regular intervals. Tender offer closed-end funds don't have the same requirement, although they offer similar levels of, or they tend to offer similar levels of liquidity through share repurchases. So what do you see as the profile of a sponsor that would seek to launch a tender offer closed-end fund or an interval fund with a PE focus? For example, what do the underlying assets look like, and what are the attributes of the structure that managers would like for this asset class?
Yeah, a couple of things we do when we start having discussions with advisors that are looking to go down the route. Many times they may have attended something like this and said they want to go down an interval route or want to go down, you know, the open-end route or something else. And we kind of backtrack the conversation and talk about what it is that they're going to be investing in, what are they trying to achieve, where their place is going to be. Because that sometimes can guide which direction we're going to go. You know, one of the key factors in you know, the registered space, especially on the interval fund side, that is pricing the funds more often. The rule requires them at least weekly. The marketplace still likes them to be daily. The platforms have a hard time when they're putting them in their mutual fund platform if they're not daily valued. So we talk to them about that and what the platforms we're going to be looking at, because if they have difficult time with RIAs buying it, you're not going to have a whole lot of success with it. But the discussions we have are around some of the basics of this. You know, what are you really going to be buying? How are you going to be able to value it? And what information are you going to be able to get from the underlying entity to be able to satisfy compliance requirements and compliance testing requirements for those investments? And those sometimes dictate which direction they're going to go, whether it's an interval fund route or the tender offer fund route. Tender offers, you know, are not going to be priced that often. Most of ours are probably priced monthly, but that monthly valuation doesn't have to occur for weeks later. We have one fund group that is a hedge fund of fund that doesn't really complete its net asset value calculation to 45 days into the period, when they're really finishing and striking that. So that's the discussions we have with them. Are you going to be able to value it, to get the information out on a timely basis to the platforms if you want to go an interval fund route? And are you going to be able to get the information to do the tax compliance as well as the tax reporting? The transparency of the underlying investments is really kind of critical to it.
Yeah, no, that's all good information. One of the things I learned early in my career is that when somebody calls and says we want to do a specific structure, it's often important to step back and say, okay, what's your assets? What are your assets going to look like? What is your strategy? And sometimes they're right. Other times they've heard about a certain structure and they assume that that's the way they should go. But these all have different benefits and drawbacks, and getting stuck in the wrong structure can be a real problem. So I think it's important what you said to highlight the fact that it's important to really look at the different structures, and if you're stuck in something that doesn't really work for your strategy, it can be a real problem later on. So one of the things that the SEC, some of the interval funds and tender offer funds that have launched a PE type focus invest in other private equity funds, or in private equity funds, I guess you could say. And the SEC has they have this informal position, although it's becoming more and more formal all the time, where they limit the amount of investment, the amount of assets that can be in private funds, in hedge funds and private equity funds, 15%. So that puts a real, that makes it difficult if your strategy is to do that, to be able to offer to offer to retail investors. And the SEC has said that if you offer to accredited investors, that's fine, you can go above the 15%, but otherwise retail investors shouldn't. This is not an appropriate vehicle for retail investors, and I think that's sort of that's a bit of an obstacle, I think, for some of the funds to be able to accomplish this type of a strategy.
Yeah, there's a couple of things that kind of come up in that. As you talked about, the SEC's limit. We always try to like to explain is if you require to be a qualified or accredited investor to buy the investment directly, then if you have it in the fund, you need to have that same qualification to it. So putting it in the fund by itself does not change who could buy it. It really depends on what that underlying investment is. And as you mentioned, we often use that 15% limit as kind of the line, although like you said, it's also kind of a moving line, but that seems to be the place that often is being hung up on it. So if you're going to be more than that, you're not going to be able to go to the retail side of it. And the other piece of it that kind of determines whether it's going to be the accredited qualified investors or retail investors is any desire to have a performance fee. You can't have a performance fee on for the retail side. Retail side only allows what's called the fulcrum fee, which you rarely ever see because people don't like the upside and the downside having to be equal on it. So to have a performance fee, you need to be only accredited. And we have lots, again, conversations where they want to start down that route. And then as they look at it, they kind of change it because of where their marketplace is going to be or what they're really trying to get at. And also may match up to what they have on their own private side. I mean, if you're starting a registered fund for really your same kind of investors, maybe it doesn't have that same meaning. Although sometimes having the registered, good housekeeping seal often is a factor that advisors are looking at too. That having it as a registered products helps them with some of their institutional buyers.
Yeah, that's a good point. So the NYSE has recently waded into this space as well. There's a rule proposal that they sent over to that's open to public comment right now recently that would, for listed closed-end funds, would formalize this 15% position. Ironically, for very different reasons than what the SEC has said in their comment letters, but Be that as it may, that's they want to formalize this position, and on top of that, they want to limit investments in a single private fund to 5%. So, I don't know if that means that the SEC is going to potentially move in that direction as well, but that's something that I think is really worth keeping an eye on, because that could, these limits could change further than where they are already. And if they become formalized at the NYSE level, it's going to be harder to push back on an SEC comment.
Oh, and I often find that kind of discussion or argument interesting, because to me, keeping it in a registered space with all the requirements that go along with it seems to be better for investor protection than having it be an unregistered private fund. So I often find when we go down routes like the New York Stock Exchange has proposed, that kind of an argument saying, is that really going to help people? I mean, they may be accredited, but they're really knowing what they're buying.
Yeah, no, I think it's a good point. I agree. So maybe we should be writing comments to the NYSE, submitting comments. I mean, for anyone who's listening, if I think the period is pretty short, but I think it's 30 or 60 days. So to the extent that that's, if you have some free time and interest, there's the ability to get involved in the process. So you mentioned the ability to take performance fees if you offer only to qualified clients for a closed-end fund. That segues nicely with BDCs, where BDCs were created in 1980. Congress passed legislation that provided for the BDC structure, and there were two reasons for this, or two primary reasons for this. The first was to give U.S. private middle market companies access to debt financing, or financing in general, really, from that they weren't able to get through banks. And so they're having trouble accessing capital, that larger companies could access. And then the other reason was, which really is more germane to what we're talking about today, was to give retail investors access to an investment vehicle that invested in private companies. And that's something that was not available to retail investors. And, it's still difficult to come by, but there are different ways to get access to it. So with BDCs, I think they're able to charge. Well, a BDC manager is able to charge performance fees on realized gains, which is similar to what you see in the private equity structure, and so they usually what used to be known as the 2 and 20 structure, 2% management fee, 20% capital gains fees. 2 and 20 is not really the market anymore, but that's still what people call it a lot of times. So BDCs are able to do that, and that's very similar to what private equity funds. Most of the BDCs are debt focused. They tend to they're seen as yield vehicles as opposed to really private equity vehicles. They work with private equity sponsors to provide the debt to a portfolio company, where the private equity sponsor will provide the equity. And so they'll usually provide the debt. Sometimes they'll get warrants or other equity kickers in order to increase the upside. But BDCs tend to largely be debt vehicles. Not all of them, but most of them are. And I think it's fair here to say that since we're not talking about listed closed-end funds, we're not going to talk about listed BDCs here either. So what we've seen in the BDC market recently, more than anything else, are private BDCs that are formed by large asset managers that already have a stockholder base that they can access. They are able to, since it's a private offering and not a public offering, they're able to sell their shares through a commitment and drawdown structure, which allows them to really get capital when they need it. So they'll get commitments for a certain amount, but they won't call the capital until they're ready to use it. It eliminates cash drag, keeps the yield up, which everybody likes. The problem is these private BDCs are not available to retail investors. They're only available to accredited investors, and oftentimes they're available. It's really it's going to be the high net worth individuals and the institutions that are already investing with the asset managers. So there's not always a lot of new capital or a lot of new investors that go into those space. It's difficult for BDCs to for a BDC to register a continuous offering because of a quirk in how BDCs are regulated. They're not technically registered investment companies. They're regulated under the Investment Company Act, but they're not registered. And the implication, the reason for that was partially so that they're not subject to all the provisions of the 40 Act, which is for BDCs is a good thing. The downside though is that by not being a registered investment company, BDC shares are not covered securities. And so if you do a public offering, a public continuous offering for a BDC, you have to register the offering in all the states. And when I say register, I don't mean a notice filing. I mean, you have to qualify the registration. You have to go through a comment process with a number of states. So, and on top of that, opposed to interval funds and certain tender offer funds, you can't get a ticker for a BDC because they're subject to suitability requirements that wouldn't allow you to do that. So from a subscription standpoint, it's a lot harder to access. It's more cumbersome to raise capital for a BDC than it is for an interval fund or a tender offer fund that's publicly offered. So I think for BDCs, the asset class, it works well for the asset class in the sense that they're able to invest across the capital stack. They can senior secured, subordinated, mezzanine debt. They can have warrants. They can have equity. And oftentimes they'll have a mix of all those. But I think from the offering side and from the regulatory side, it's a little bit more difficult to access the retail markets unless you're listed. So,
and we've had, if I could, we've had a more recent, interest in the BDCs. It had died off for a couple of years. A lot of it tied into the fiduciary rule and the fees that were being charged on BDCs. But like the private equities, we've been having a lot more interest, a lot more discussions with BDCs trying to go down the route that you described as the vehicle of choice for what they're looking at. So
that's good to hear. I think it's a great structure for this asset class, and some of the issues that I think some of the non-traded BDCs had. I think the second time around would be. I think you could avoid some of those, and really, Alrock is out there right now raising tons of money, so it can be done. It's just it tends to be a little bit more cumbersome, and so if the right managers are willing to deal with the regulatory issues, I think it can really be a good structure for this kind of asset class. So real quick, the last one that we mentioned was it's called an auction fund. And it's a variation of a closed-end fund that can, or it can also be a BDC, although we haven't seen that yet. In an auction fund, you have a closed-end fund or you have an interval fund, and the way that liquidity is primarily derived for shareholders is through the matching of buyers and sellers in an organized market auction that's operated by the NASDAQ private market. And so the goal is to, in some respect, replicate the price discovery process that you see with ETFs. Liquidity, generally quarterly or monthly, certainly not daily like you see for some other products. And the auction price is really going to be determined by supply and demand for the shares. Only certain entities are eligible to participate in the auction process. Individuals are not able to do that. And the price is probably not going to be NAV, but it's going to be hopefully close to it based on the kind of mechanisms that are put in place to make sure that that's the case. The benefit I think to this structure is that the fund doesn't have to hold cash or other liquid investments to satisfy repurchase requests, because you generally don't have repurchase requests in this kind of a structure. It might be a backup, but most of the liquidity is really going to be derived through the auction process. So it looks a lot more like a permanent capital vehicle than the other models that we've talked about, and they can invest a larger proportion of their capital in illiquid investments because they don't have to keep a slug of 5% or whatever in liquid investments or cash. So it's a pretty new structure. There are a couple of funds that are out there that are doing this. The first one that went out, it's an accredited only product. That's a fund of funds. They're investing in other private equity funds, and because they exceed the 15% limitation, they are they're only offered to accredited investors. So I think it's something that we're keeping an eye on. It's new. It's a very new product. We'll see how it works, and we'll see if it really lives up to everything that it's supposed to live up to. But that's where that is. So we've got a couple of minutes left. I don't see any questions in the chat box. Is there anything else you want to, or maybe I'm clicking on the wrong box, but anything else you want to talk about, Terry?
No, I talked about some of the issues or barriers that we talk to advisors on, or to think about when they're going down the product. One of the other ones we do is we get the audit partner involved in the discussion very early on, because many of those questions are ones that have to be done during the audit. The auditors are going to have to approve or look at the valuation. So understanding the valuation methodology that they're going to use, and whether the auditors can get comfort with that methodology that's being used, or the process and how they're going to do it. The other key one that often comes up on some of these, maybe more on the credit side than on the private equity, but even with that, is the proof of ownership. How are they going to prove that the fund has that ownership when they're in that kind of a world where we don't really have custody holding some of these records? How can they prove that ownership, and how can they prove the look through, like I mentioned, to be able to do to prove the compliance and to meet your income distribution requirements. So we often talk about that, and also talk with having the auditors involved, like I said, early, so that they can understand it. And that sometimes gears which way direction we go. So.
Mm-hmm. No, good advice. I agree. All right. Well, I think, look at that, 10:59. So we're ending right on time. Thanks so much, Terry. I appreciate it. Thanks for joining today. That concludes today's chat. Our next coffee chat will be hosted next Wednesday, May 12th. My colleague Craig Foster will discuss how to manage cybersecurity and privacy risks in vendor engagements. To register for this or future coffee chat discussions, visit the events page on Thompson Hine's website. And we encourage you to view our library of past coffee chat recordings, which are available both on Thompson Hine's YouTube channel and in the investment management section of our website. We want to thank you all for attending today's program, and extend a special thank you again to Terry for sharing his insight. When the webinar ends, you'll be prompted to take a survey providing feedback. Thanks again, stay well, and enjoy the rest of your day.
Thank you.